Good day, class. Welcome to the second session of Demonstrate an Understanding of the Function of the Market Mechanisms in a New Venture. In this session, we will analyze the interaction of demand and supply in price determination. The law of demand states that if all factors remain the same, if the price is high for a good or service, then the demand will be low. Another way of interpreting the law of demand is that if all factors stay the same and you sell a loaf of bread at 10 Rand, you would sell more loaves of bread than you would be selling at 20 Rand a loaf. The law of supply is somewhat the opposite of the law of demand. If the price of a product or service is higher, then there is a greater quantity supplied for that particular product or service. Producers are willing to supply more products and services at a higher price because it offers greater revenue. Demand refers to the quantity of a product or service desired by a consumer. The quantity demanded is the most amount of a product that consumers are willing to buy at a certain price. The relationship between price and quantity demanded is known as the demand relationship. Supply represents how much the market can offer. The quantity supplied is the amount of a certain good producers are willing to supply when receiving a certain price. The relationship between price and quantity of goods or services are supplied to the market is called the supply relationship. Price is a reflection of supply and demand. Demand depicts the quantity of a product consumers are willing to purchase at different price points. Due to having limited resources, we need to decide what we are willing to purchase at what price. If petrol is 5 Rand per litre, on average, consumers may be willing to buy 50 litres per week. If the price drops to 3 Rand per litre, they may be willing to buy 100 litres per week. And if it were dropped to 2 Rand, they'd be willing to buy 250 litres per week. Demand shows the consumer side of purchasing decisions. Supply shows the producer's desire to make profit. A supply schedule shows us the quantities that suppliers are willing to offer at different prices. Suppliers have different costs of production. At low prices, only the efficient producers can make profit. At higher prices, even high-cost producers can make profit. Continuing from the petrol example, oil companies may be willing to supply certain amounts of petrol at certain prices. At 2 Rand, they are willing to produce 50 litres per week. At 3 Rand, they produce 100 litres per week. And at 5 Rand, they produce 200 litres per week. Suppliers want to provide products at higher prices, and consumers want to purchase products at lower prices. In order to determine the price and quantity of goods in the market, we need to identify the point where consumer demands intersect with the amount that suppliers are willing to supply at a certain price. This is called the point of equilibrium. A shortage occurs when the demand is greater than supply, and a surplus occurs when the price is too high and consumers don't want to purchase the product. The fact that prices and quantities tend to move towards equilibrium in the free market system helps us keep the market stable. Going back to our petrol example, if we draw out graphs, we see that the supply and demand curve intersects at 3 Rand for 100 litres per week, which is where the equilibrium would be in our instance. Factors of production are the resources used as building blocks of the economy. Primary factors are land, labor, and capital goods. Materials and energy are secondary factors because they are acquired from primary factors. Primary factors help facilitate production. They do not become part of the final product, nor do they get significantly changed by the production process. In order to get a clear breakdown of each factor of production, I recommend that you go over your learner guide. Otherwise, let's move on and look at the role of money in the economy before we end our session. Money is a medium of exchange between individuals. It is used to distribute ownership in society. even though it may be an imperfect tool. The purpose of money as a medium of exchange required that money should act as a measure of value in order to determine the worth of an item. Money itself has no value, except in terms of goods and services that you can purchase in exchange for a certain amount of money, depending on the worth of the good or service. Money helps compare the worth of a commodity in relation to another commodity. Since money is neutral, it guarantees that money fulfills its purpose of facilitating exchange and promoting economic growth. Money is the tool that defines the position of an individual in society. Money is the tool that creates social disparity between people. Money creates inequity when it comes to distribution of wealth between people. We have come to an end of the second session. Let us take a break and continue with the next session after our break.